on your loan. You sigh with relief. You did the responsible thing. But here's the uncomfortable part. Most of that payment didn't reduce what you owe, and it didn't really go to the bank either. It went somewhere else, quietly, automatically, and almost no one can clearly tell you where. That's the real story of interest. Right now, household debt is at record levels. Credit cards, mortgages, student loans, auto loans, trillions outstanding. At the same time, interest rates jumped faster than at any point in decades, which means more people are asking the same simple question. When I pay interest, who actually gets it? Because it doesn't feel like it's helping you, it doesn't feel like it's stabilizing the economy, and it definitely doesn't feel like it's going to some helpful place. So let's slow this down. No jargon, no whiteboard math, just the system as it really works. Imagine you take out a loan, any loan, a mortgage, a car loan, a student loan. The bank says, "We'll lend you money, but you'll pay us more than you borrowed." That extra amount is interest. Most people assume interest is just the bank's profit. Simple. End of story. That assumption is wrong. When you pay interest, your money splits instantly, like water through pipes you never see. Some of it goes to cover the bank's own cost of borrowing. Some of it goes to investors who never met you. Some of it goes to insurance-like systems protecting the bank if you default. Some of it goes to the financial plumbing that keeps money moving. And only a slice of it ends up as actual profit. Let's start with the most important misconception. Banks do not lend their own money. That sounds insane, but it's true. When you take out a loan, the bank doesn't open a vault and hand you cash. It creates new money digitally. A number appears in your account. That's it. But here's the catch. Even though banks create loans, they still have to fund them. They need reserves. They need liquidity. They need to meet regulatory requirements. And they do that by borrowing money themselves. From where? From depositors, from money markets, from pension funds, from insurance companies, from other banks, from the central bank. So when you pay interest, the first question isn't, is the bank getting rich? The first question is, who did the bank borrow from? Because those people get paid first. Let's say you pay $1,000 in interest this year on your mortgage. A chunk of that goes to people who put money into savings accounts, money market funds, or bonds. Not directly, but through layers. Your interest payment helps fund the interest paid to retirees holding bank bonds. It helps pay institutions parking billions of dollars in short-term lending markets. It helps support funds that hold mortgage-backed securities. You've probably heard that term before, mortgage-backed securities. It sounds abstract. It's not. Your loan gets bundled with thousands of others. That bundle gets sold, then resold, then sliced into pieces. Different pieces pay different investors. Some pieces are considered safe. They get paid first. Some pieces are riskier. They get paid later, but earn more. When you pay interest, you are feeding that machine. And most of the people receiving it have no idea who you are. That's not a conspiracy. It's just scale. Now let's talk about the bank's cut. Banks make money on the spread, the difference between what they charge you and what they pay others. If they pay 3% to borrow money and charge you 6%, the spread is 3%. Out of that spread, they pay salaries, they pay rent, they pay compliance costs, they pay for software and fraud systems, they pay for losses from people who don't pay back. Only after all that do shareholders get what's left. Which leads to the next uncomfortable truth. When interest rates rise, banks don't automatically win. Sometimes they get squeezed. If rates rise too fast, the cost of borrowing can increase faster than what banks earn from existing loans. That's one reason banks fail, not because loans disappear, but because timing kills them. So if banks aren't the final destination, who else gets paid? The answer gets more unsettling. A large portion of interest flows into passive investment systems, pension funds, sovereign wealth funds, endowments, insurance portfolios. These institutions need steady, predictable returns. Loans provide that. Your interest payment might help fund a teacher's pension in another state, or a retirement system in another country, or an insurance pool designed to pay out decades from now. That sounds almost noble, until you realize what it implies. The modern economy depends on people staying in debt. If everyone paid off their loans tomorrow, massive pools of capital would lose their expected income streams. That's not a theory, that's math. Now let's zoom in to the part most people never notice: amortization. When you make a loan payment, the early payments are mostly interest, not principal. This isn't an accident, it's structural. In the early years, your balance is high, so interest is high, even if the rate stays the same. So this means the system gets paid first. You take the risk, you commit your future income, but the system extracts value up front. By the time you start meaningfully reducing the principal, years have passed, sometimes decades. This is why people feel trapped even when they do everything right. Now, here's where the irony creeps in. Interest is often justified as the price of risk. You borrow money, the lender takes risk, you pay for that risk. But most large lenders don't hold much risk at all. They sell it, they insure it, they hedge it. Risk gets distributed, diluted, and priced by algorithms. The borrower keeps the most concentrated risk: job loss, illness, inflation, life. The system keeps the cash flow. Now contrast that with the hype. We're told interest encourages responsibility, that it rewards savers, that it allocates capital efficiently. Sometimes it does, but sometimes it just amplifies power, because those who already have money receive interest, those who need money pay it. Interest flows uphill, not always dramatically, but consistently. Over time, it compounds. That's the quiet part no one advertises. Now let's zoom out. Multiply your loan by millions of people, multiply that by decades, then scale it globally. Interest payments are one of the largest transfer mechanisms on Earth. Households to institutions, workers to capital pools, present labor to past wealth. This isn't inherently evil, but it is rarely neutral. When interest rates rise, the burden increases instantly for borrowers, but the benefit flows slowly and unevenly to lenders. Some savers win, some institutions win, some governments struggle because their own interest costs explode. So which brings us to the final uncomfortable layer. Governments also pay interest. And who gets that? Often the same institutions holding private debt. So the public pays interest through taxes, while also paying interest personally. Two streams, same destination. Again, not a conspiracy, just structure. And that structure was built over decades, quietly, incrementally, optimized for stability, not fairness. So when you ask, who gets the interest when I pay my loan, the honest answer is not a single entity, it's a system. A system that prioritizes predictability over flexibility, cash flow over resilience, and continuity over forgiveness. And here's the final twist. That system only works if people keep believing interest is just a fee, not a power mechanism, not a wealth channel, not a design choice, just a number on a statement. So the next time you make a loan payment and see how little went to principal, ask yourself a different question. Not how fast can I pay this off, but what kind of economy needs this to function? And what happens if one day it doesn't?